Welcome to the weekly wrap up. Guys, we are ending the week about the same as where we started the week for interest rates. So that is a good thing, in my opinion, because in the middle of the week, we've been a little around the board. So two big reports that came out this week, which were very interesting, the way that the bond market reacted. We had GDP, which is basically showing how much our economy produces, which is also how kind of hot our economy is, how much growth it's expecting. That actually came out much higher than expected, which normally would cause interest rates to go up, but they didn't. Interest rates actually rallied and came down on that news, which is actually polar opposite of what normally would happen. We also had PCE numbers. That's personal consumption expenditures. That's basically consumer spending. Now, those numbers were quite a bit higher as well, which again would typically cause interest rates to go up because it means that consumers are spending way more, heating up that economy, causing some inflationary concerns, and that would mean the Fed is going to come in and keep interest rates higher for longer. But it had the opposite effect. But I think what is really happening when you really deep dive into some of these numbers, number one, consumers can't keep spending at the rate they're spending. Right now, they're spending roughly double what they're bringing in. So that's not sustainable. They're also saving fractionally less. So just to give you guys an idea, in the month of September, the average consumer saved about 3.7%. And in the great deep recession of 2008, they saved 2.9%. So right now, we are saving very little. We're still spending and we're racking up all of our credit card debt and things like that, which has limits. So the behaviors will change. And the point is when they change, that's when we're going to get some not great reports. And that's when we're probably going to see interest rates come down. So hopefully that will happen early next year. Hard to tell, but when consumers stop spending, we will definitely see interest rates make some movements lower. So important things to note for you guys. We are spending lots of time with clients on reorganizing debt. So clients that maybe are like, oh, my house payment's a little bit too high. How can I make that work? We're looking at what other debt can we pay off? What other debt can we reorganize to make room for that mortgage payment so that their monthly output is the same or less than when they're bringing on that mortgage. So a lot of time with looking at debts, looking at budgets. How can we make this work? The other thing I want to make sure that you guys know, we got two events coming up. We got the Phil Jones event. I think we only have 50 seats still left. So if you want to attend that, please sign up on the link below. That's November 16th. And that is a big deal that he is coming here. The other thing is I am going to be doing a Zoom and Learn. And that is going to be all about how to convert leads in a high interest rate environment. There are lots of things that we're going to talk about there with regards to scripting, with regards to data that we can show them, with regards to just kind of handling some of those objections to really open clients up about buying even in spite of the interest rate. So make sure if you want to attend those, RSVP below. If there is anything extra that we can be doing for your clients or any clients that are sitting on the fence because they're just not sure, we would love to have a conversation with them about the options that are out there, buying now versus waiting until down the road.